Really appreciate you tuning in. You're awesome for sticking around and joining the fun. Let's dive into how HDFC FlexiCap and HDFC Midcap Growth Funds have performed over the last 18 years for SIP investments. It's going to be interesting. Putting in a one-time lump sum of 50,000 rupees last year into each fund, totaling 1 lakh rupees, has seriously paid off. Can you believe it? I've already raked in a sweet profit of 5,000 rupees. How awesome is that? Imagine if we kicked off our investment journey back in 2007. Putting in 5,000 each into 2 funds. That's a total of 10,000 rupees every month. Over the last 18 years, I've invested around 22 lakh rupees. And guess what? It's ballooned to a whopping 1 crore 18 lakhs. How amazing is that? Compounding is where the real magic happens. Think of growth mutual funds as your best pals for making money. The sooner you invest, the more you can rake in. Just a quick reminder. Past performance doesn't always promise future results, right? I mean, someone who invested back in 2000 saw their money grow 60 times. But then there's the 2010 investor who only got 7 times. So, let's keep our expectations realistic. Starting to invest in mutual funds in India can be a great way to build wealth over the long term. For an early starter, a systematic and disciplined approach is key. Here's a simple plan to follow. Define your financial goals and risk tolerance. Before you invest a single rupee, you need to answer 2 fundamental questions. What are you saving for? Your goal determines your investment horizon, how long you will stay invested. Short-term goals: 1, 3 years. Buying a new gadget, a down payment for a car. Medium-term goals: 3 to 5 years. Saving for a vacation, a down payment on a home. Long-term goals: 5 years. Retirement planning, a child's education. What is your risk tolerance? This is your comfort level with market fluctuations. Conservative: you prefer stable returns and are not comfortable with your investment value going down, even for a short period. Moderate: you are willing to take some risk for potentially higher returns over the long term. Aggressive: you are comfortable with high risk and market volatility in exchange for the possibility of very high returns over a long period. Choose your investment method. SIP is best for beginners. For a beginner, the systematic investment plan SIP is almost always the recommended method. What is a SIP? It's a way of investing a fixed amount of money at regular intervals, usually monthly. You can start with as little as 100 or 500. Why is it great for beginners? Financial discipline. It instills the habit of saving and investing regularly. Rupee cost averaging. When the market is down, your fixed investment buys more units. When the market is up, it buys fewer. This averages out your purchase cost over time and reduces the risk of investing all your money at a market high. No market timing. You don't have to worry about whether it's the right time to invest. The alternative is a lump sum investment, which is a one-time large investment. This is generally more suitable for experienced investors who can time the market. Select the right mutual fund category. Based on your goals and risk tolerance, you can choose a suitable category of mutual funds. For moderate to aggressive investors with a long-term horizon 5+ years, large cap funds invest in the top 100 companies in India. They offer more stability and are a good starting point for equity investing. FlexiCap funds give the fund manager the flexibility to invest across large, mid, and small cap companies. This can provide better diversification. Index funds. These are passive funds that simply track a market index like the Nifty 50 or Sensex. They have very low fees-expense ratio and are excellent for beginners who want to grow with the overall market. The practical steps to start investing. Complete your KYC. To invest in any mutual fund in India, you need to complete your Know Your Customer KYC process. You will need your PAN card and address proof. You can do this online or through a mutual fund distributor. Choose an investment platform. You can invest directly through an asset management company AMC website, or through a third-party platform like Grow, Zerata Coin, or Pata Money. Choose direct over regular. When you invest, choose a direct plan over a regular plan. Direct plans have lower expense ratios fees, as they don't involve a distributor's commission, which means you get to keep more of your returns. Start your SIP. Log in to your chosen platform, select a fund from your chosen category, and set up a monthly SIP for an amount you are comfortable with. Remember to link your bank account for automatic debits. Monitor your investments. Check your portfolio every 6 to 12 months. Don't panic over short-term market dips. Mutual funds are a long-term game. By following this plan, you can begin your investing journey in a structured and responsible way, setting yourself up for long-term financial growth. If you enjoyed this, give it a thumbs up and hit that subscribe button.